I just want to make everyone aware that the really big deal in the new Tax Act is the opportunity to pay less income tax on business income. I mean, that really is the sexy part of the new Tax Act, is saving income tax on business income. And they do that in two ways. One is if you're a C Corp now, instead of a 35% rate, you're down to 21%. And the second way is if you own a pass-through, like a partnership or an LLC or even a sole proprietorship. That business income now is taxed at a lower rate. So the top rate is 37% now. Pass-through income gets a 20% deduction off of that. So the effect is that pass-through income is only paying at 80% of that 37%, which means that the pass-through is really being taxed at 29.6. So the winners in this new Tax Act is business income. And I'll show you that there are some exceptions. This thing is riddled with exceptions, but the bottom line here is basically service businesses don't get to do it. Look at this next slide and you see the 8 words at the bottom there. You have health business. So if you're a doctor, it doesn't work for you. If you're a lawyer, it doesn't work. Accountant, it doesn't work. All this. Consulting doesn't work. Investing, it doesn't work. So that's something. It's not for everybody. I'm going to tell you the bottom line on this. The more you look like Donald Trump, the better the Tax Act works for you. That's the reality, okay? Hair included. Hair included. Yeah, there you go. Yes?
Is an S-Corp not a pass-through?
S-Corp is a pass-through. Yes. I'm sorry I didn't mention it, but S-Corp is a great example of it. You got it. So look at the one. There's a chart that's got some purple boxes on this big purple box with different shades of purple on it. Let's go to that one.
Can we go back to that, though?
Yeah.
Sure.
Every C corporation I have, I've been told, will pay that 21% tax.
Every C.
Every C.
Yeah.
However, I've been told that if I have 10 or 20 LLC or S's, that
Pass-through deduction.
one to me.
It's only they aggregate it.
Yeah.
Yeah.
So
That's right.
They don't get treated the same.
No, it's right. C Corps are very different from pass-throughs, and there is this knee-jerk thing going on right now about, well, hey, C Corp is at 21. That's the lowest rate of all. I should have everything in a C Corp. Well, not necessarily so, and we're going to talk about that in a minute. If where it's the right thing for you to do, it is the lowest tax rate, but it's not going to be right for everybody. But let's look at this purple page for a sec. On this new 20% pass-through deduction, this thing's complicated. If your income is below certain levels, like 157.5 single or 315 married, you're home free. You get to take the 20%, even if you're a service business. If your income's between some levels, if you're, say, married and you're between 315 and 415, you get partial benefit of the 20. But let's go to that next one. If you're over 415,000 married, if you're an income from a service business, you get 0 deduction. And the final column there, if you're not a service business, you still get the 20% deduction, but it's subject to what's called a wage cap. So again, we won't go into all the details, but basically this law is designed to help businesses that have a good-sized payroll. If your business doesn't have a good-sized payroll, this is probably not going to help you. And the exception to that is unless your business owns a lot of tangible assets like real estate. Then you're okay. Okay? Again, if you look a lot like Trump, you're okay. This next slide's kind of talking about that. Let's go to the slide here with the 2 colored boxes. A tale of 2 pass-throughs. And here's where I'm picking on on Donald Trump again, but the orange box with taxpayer Donnie. Okay. Versus taxpayer Doc. Okay, look at the orange. Donnie is a real estate developer. We have $5 million annual income. He's going to get a deduction every year of that income of $1 million. We're going to assume that that he reinvests 80% of his profits every year in his company, and that reinvested earns 7% rate of return. 20 years down the road, what's it grown to? And it's grown to $1.2 million. Doctor, same facts, but this heart surgeon, after 20 years, has $89 million in his pocket. So the point we're making, of course, is Donnie is about $15 million ahead of Doctor at the end of 20 years. And that's just the way the law works. Let's go to the next slide. This is a purple slide again, a tale of four.
Can I ask you one question?
Yes, sir.
So if you own a lot of assets, could be real estate or personal property.
Mm-hmm.
And so if personal property you're only leasing out, is that?
That's okay. Yeah, so if your business owns like equipment that you're leasing out, that business can qualify because it's got a lot of assets in it. They're basically looking for companies that either have a lot of payroll or a lot of assets.
Capital-intensive business.
Capital-intensive businesses.
Yeah.
Exactly. This slide, this next purple one, is saying, okay, we have a tale of four taxpayers, and we're just looking down the road 20 years to see how each of them does. And what it's showing you is, do you want to be a C Corp or do you want to be a pass-through? The first guy is a pass-through who got no deduction. That's our doctor, our heart surgeon. He grew to $85.9 million. The second line is a guy with a pass-through that does qualify for the deduction. His growth to 99.7, so he's way better. The third line is the C Corp guy. But at the end of 20 years, he has to take the built-up money in his C Corp and pay it out to his family as a dividend and pay a 20% dividend tax. And you'll see that the family at the end of 20 years is at $93.6 million. So they're not as good. The C Corp here is not as good as the pass-through. You're thinking, wait, the C Corp pays income tax at 21 and the pass-through pays income at 29. Why is the pass-through better? And it's because you got to think about the end of the day. There's a second layer of tax that hits a C Corp, and that second layer of tax does not hit the pass-through. But number four, the best of all, C Corp, where you leave it in the C Corp till you die. So if you can park it in your C Corp until you die, then your family gets a stepped-up basis. They can pull the money out at that point, dissolve the company, pay. They don't pay the second layer of tax. So the guy who stayed in the C Corp till he died, the family accumulated up to 117. So you see, the best of all was a C Corp that you kept intact till death. Next slide, and again, I'm just hitting high points here. I know we're kind of going to run through a bunch. The next slide is this, what I'm calling the half and half. And I got interviewed just last week by the Wall Street Journal about this. I don't know when the article come out. A fellow named Robert Rubin called me and said, I want to write an article. I've heard about your half and half. And that's what this is. And it's a deal where you're, actually I'm looking for the one that, I don't see it right in front of me, but anyway, it's this one that, so let's say your company, you own a company and you say, look, I need half of that money every year to come out to me, and the other half I'm going to leave in and accumulate. In a case like that, where you're not going to take it all out, you're only going to take out half, instead of having it all be a pass-through or all be a C, the best solution is a half and half, so that your company is basically owned half by you and half by a C Corp. So you set it up in a pass-through. You set it up like a limited partnership. Your company, the operating company, is a limited partnership. And who owns the limited partnership? It would be owned half by you and half by your C Corp.
Right.
And that half and half produces the best outcome. And if you look at this chart here, then right here, it shows you that if you wind the clock forward 20 years, if I had been entirely a C Corp, I'd have 192 million. If I'd been entirely a pass-through, I'd be at 196. But if I'd done a half and half, I'm at 213. So here's the lesson of this.
So you're getting the benefit of 2 and the benefit of 4.
Yeah, and exactly.
Yeah.
And so the bottom line is that you got to do the math on it. It's a numbers game, and you can't just assume that the right thing to do is one or the other.